You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. It's Trent Fleskins here, your host. As always, this week we've got one of the crowd favourites in, is Lachlan Delahunty from Performance Property Advisory, to have a chat about where the market sits in Q4. It's hard to believe we're already in Q4 of 2024. What a ride this year has been. We haven't seen it since the mining boom, have we?
We haven't. It's always good to come in here, Trent, and talk where things are at.
Props to you. A year ago, you sat with me in the office and you said, Trent, bet ya, I reckon it was a bottle of something that
Definitely
we're going to
was.
see 25%
Bottle of Verve. Yeah.
in 2024. And I said, mate, that's pretty ambitious. Certainly we'll see growth. Certainly it'll be double digits, but I don't believe it'll be 25%. Currently, I'm winning that. It's 24.6%. So you haven't got your bottle yet.
I haven't yet, but I'm confident in the last quarter.
Yeah, we've got a couple of months left to go. And I think that's the point of this conversation today, to have a quick chat about what we've experienced over the last few months since you were in pre-winter, what that winter's look like in the established market where you focus, but also a conversation about most contemporaneously the last few weeks, about where the market's been, a little bit of chit-chat on that, and what we expect for the next couple of months, where the focus should be, where you're buying right now, why you're buying it, what you're buying. A little bit of a conversation as well about that value in this market too, about buyers agents, as we always do. Let's start that conversation today with a little bit of a chat about the last 4 or 5 months. Yep. How was winter in Perth's property market?
It's as hot as I've seen it. So we've been running pretty much for the most part of the year since January. The market has been running strong, pretty well close to 2% growth month on month. So that winter lull that people were probably hoping for, I think we spoke back in June, and a lot of people, saying there's not a lot of stock on the market, everyone's going to wait till spring. That lull of activity didn't slow down. You've seen that in the transactions, and we've seen that in the growth. So the March to September period was as strong as we've seen in really any years leading up to this, with the exception of the mining boom.
We saw some step changes in pricing too, in especially the land estate side, which for me demonstrates as a substitute to the established market that some people are maybe losing a bit of hope, or have lost a bit of hope even in the start of the year, and then made that decision in winter, simply just being able to compete in the established market.
Yep, there's such a shortage of stock available, and there's also, it gets to the point in time when the established market continues to run, land starts to represent value. When you look at the the cost to build with that land versus established prices, it starts to become a solution because people get exhausted from missing out in the established market. But I guess in recent weeks, to lean on that, over the last 6 weeks, I've noticed a little bit of buyer fatigue hit the market, and there has been a bit of chit-chat. We'll start to see a lot of East Coast podcasts and or buyers agency jump off the Perth bandwagon as soon as they can. Obviously being located on the East Coast, it's very difficult for them to service the market. So
it's convenient for them to tell a story, I think, about how Perth's had its run or it's overcooked to the extent that they could argue that. Because, of course, it makes sense. They want to be buying in their backyard where their relationships are, where they can drive to the property rather than fly to the property. It was always going to happen at some point that the East Coast was going to be first in the market, coming with their experience of growth and the bravado from the East Coast, but also probably first out of the market, because why would they want to be bothering coming over here when they could tell half a story about how, for example, Melbourne's market is coming back at some point in the next few years? Yeah,
it's just easy for them to service local markets on the East Coast. So Perth is an inconvenient market for that. So there's been a little bit of a narrative around that I've just picked up on in the last 6 weeks. But locally in the market, there is a little bit of fatigue, and that is very normal. And we've seen that in different cycles, both in the Brisbane and Sydney markets in previous years. If I look at Sydney back in 2017, once you go through a period of growth like we've seen this year, and we also saw it last year, and people forget that, the market to the back end of last year, November, December, there were some really good buying opportunities. People typically can give up later in the year and just put it to bed and say, we'll wait for the new year. So we are certainly seeing better opportunities, slightly more stock. It's up about 25% from last month, 4 weeks ago. But again, when we look at properties on the market here in Perth, there's 4,700. Would seem like a lot when you consider 4 weeks ago it was 3,800. This time last year it was over 5,000. So in context, we're still very much in an undersupplied market.
In context, we're still a quarter of the amount we saw in 2019.
Exactly. So it's the fundamentals of the market still remain extremely strong. You can see that in the local data sets. You get some wind that the market's overheated, Perth can't continue to rise. It's just fundamentally incorrect when you look at the data. The data's never looked this good in terms of affordability, still quite strong for Perth, albeit it's gone up and it's gone on a run. Understand for the first part of last year and a portion of this year, we still were just catching up. Obviously, we've pushed past that, but from an affordability, when we track the affordability index in comparison to other markets, Perth, with the exception of Darwin, is still the most affordable market. We've got 1,500 people coming into the state per week, and on the building approval side, we're approving about 1,500 a month. So, 1,500 people a week coming in and only approving, which is 12 to 18 months from coming out of the ground a month. As you can see, the demand-supply dynamic is still well in favour of an aggressive market moving forward.
I think it's important to quickly characterise what a softening market looks like. And why will we do that? Because, well, if we're going to have people challenging the fortitude of Perth's market going forward, well, then you need to give us an argument as to how that occurs and what that looks like and how do we characterise that. So when we're in a market that is softening or dropping, the first thing we actually see, which is why supply would go up, is a dropping of demand. And how do you track a dropping of demand? Well, you see that in a dropping of transactions, because the transaction doesn't happen without demand. The supply's there, so the half of that transaction sitting there every week. It's just under 5,000 properties. So there's always that side ready to go. So the transaction doesn't happen without the demand side. And the interesting thing we've seen is demand is actually picking up every week at the moment. It's been in the mid 800s to mid 900s for most of the year. It did skirt down to the lower 800s over the last few weeks into September. We just had 911 transactions last week. That's actually the largest number we've had in a couple of months. So stock on market isn't increasing because we're not buying as many properties every week because the buyers are pulling away. In fact, if the East Coast buyers are pulling away, they're clearly being replaced by owner-occupiers and investors in Western Australia who are getting their opportunity finally. Now, why is stock on market coming on? Well, because it's the spring selling season. This is the time that people every single year generally will wait to put their property to market. And we're seeing stock rising simply because a few more people are putting their property to the market this year relative to demand than throughout any time in the rest of the year. And that's normal. That's why it's called spring selling season. But when we think about the characterization of this year in terms of stock on market, it's the lowest year we've ever had in recorded history per capita of stock on market.
Yep.
It's still lower than last Christmas. It's pretty much the same market in terms of how much stock on market we had in February. No one had any concerns about the market in February.
Correct. So
we don't expect there to be that issue. Even if we do tick up to 5,000 properties or just above that over Christmas time, we are still in relatively an impossibly undersupplied market that, as you just referenced before, how do you fix that? Well, you have to add supply, add new housing. And as you said, if we stopped immigration today, we'd actually still have a couple of years of catching up. But given we aren't stopping immigration right now, let's say it's 60,000 people we're probably going to have come into Perth this year, needed about 30,000 homes. We're approving about half of that.
And approvals still take 12 to 18 months to get out of the ground.
Yeah. And so that is the dynamic of, well, how do we enter a softening market? Well, we expect to see the buying side, the transaction side drop to 600 transactions a week, which would in turn mean stock on market is in relation to that increasing, but it's not. It's not happening because demand is dropping. Demand is staying constant, if not rising back up again.
So yeah, exactly. And when we look at markets to see if they're going to rise, fall or hold, three fundamentals that we look at as a business is where markets where demand exceeds supply, there's confidence in the market. When we talk confidence, we're talking wage growth, we're talking a strong employment, which all the characteristics of the Perth market currently, and we talk affordability. If those three things are in place, we typically see markets run. And when we look at Perth at the moment, it's very clear to see that demand still exceeds supply. There's a lot of confidence in the market because a lot of money washing around Western Australia, jobs growth is really high, our unemployment rate is extremely low, and we're seeing more immigration coming in for that workplace employment. So those three parameters that we look at for any market around Australia still creates a case for Perth over the coming 18 months and likely beyond that.
So when you talk about buyer fatigue,
Yep.
What specifically is it coming from? Is it simply people readjusting their expectations? If they got a pre-approval for $1 million 6 months ago, still haven't been able to buy that property. That property is now pricing at 1.2 and they're scrambling to wonder how they're going to afford it. Mm-hmm. Or is it I've turned off Perth. I live in Perth. I've decided I'm not going to buy anymore. I'm going to rent, or maybe I'll build.
It's a combination. Perth's not in isolation. This happens in every market somewhere in Australia at any point in time. Like I said, we've seen in Sydney in 2017, Brisbane in 2022. When you have 9 months of upswing in a market, we typically see the last quarter of the year can be slightly steady, or it can fall away due to buyer fatigue. And the reason it is because you look across all data sets. Sydney, for example, auction clearance rates are the highest in January. You typically see the best results in terms of days on markets, etc. in any other market in January. People get back from the new year. People have had time to digest, have had a break, and typically on one of those agenda items is we're going to buy an investment property, we're going to buy a house, we're going to upgrade, we're going to do something this year. So people get back from their holidays. You always see back end January, early February, the markets are typically at their absolute hottest, and that's where we see the highest clearance rates. That then can flow on from there, and as we saw from January...
Sometimes doesn't,
yep.
But this year it did.
It did. The momentum picked up and away it went. And then a lot of people, be that for owner-occupier purposes, trying to chase a rising market can be difficult, as we've discussed on the podcast previously. If you're not in front of the market, you typically fall behind, and when the market's moving at the pace it has been, 2% a month, you see a lot of people, both investors and owner-occupiers, are constantly coming in second, third, fourth, sometimes 10th in line. And that process, when it's happening on repeat, becomes very disheartening. I had a friend referred me, one of their mates, about 6 weeks ago. They've been looking to upgrade into Doubleview. And when we caught up for a coffee to talk through their experience, they'd missed out on 37 properties throughout the year. Started the journey late last year, early into January, very similar to what we were discussing. And they've missed out and put offers on 37 properties. So fair to say they were a little bit annoyed. Yeah, but with the industry, obviously you start to try to blame things. Real estate agents, easy people to blame. They're just doing their job. They work for the sellers. The industry itself, the market, you just become completely disheartened. So you can imagine why they're fatigued. The conversation was, we've had enough. They just start to justify, we're happy where we are. We're just going to put it off till next year. And I think that's probably consistent with a lot of people in Perth, albeit they're not an extreme example of missing out on that many properties. And to understand, to actually miss out on 37 opportunities when you've got to contract stage means you've probably inspected 4 to 5 times that, right? So that conversation was had, and it's just interesting because this point in time where I've noticed within our business, we've seen some of the better opportunities pop up in the last 4 to 6 weeks because of this buyer fatigue. We're not competing with as many buyers as we were 10 to 12 weeks ago, even 3 to 6 months ago. And our off-market conversion rates just ticked up last month at 67%. So we're starting to see those better opportunities because a lot of people are disheartened because they've gone through that process. And now we're getting so close to Christmas, the easiest thing to do for buyers is to say, let's just park this.
So how do we explain a market where demand is constant, if not slightly rising, supply is increasing, and prices are increasing? We saw obviously CoreLogic come out with data in September that even though stock on market has risen pretty much through September was where it was happening, but we still see prices rising 1.6%, which is more than some cities will do all year. The point here I'm saying is that you can have a market where supply is rising broadly, albeit in the lowest region it's ever been, and also still growing. It doesn't have to be an inverse situation, right? As long as demand still stays constant, as long as you've still got multiple offers on every property, you're still going to have competition for those properties and people paying more than they did last month, even though they have 2 or 3 more options in the suburb to look at. There's still that many buyers. There's still that much competition on every offer.
That's what we're seeing in the market, right? And I think when we look at different segments of the market, I do see the top end of town, north of 3 million, your Cottesloes, for instance, we picked up a really good buy recently in Brighton Street, 3.2, that's a $3.6 to $3.7 property every day of the week. And I think the reason of that, the buyer pool at the higher end when interest rates are where they're at, is taking a bit of a toll. But come down to more affordable markets, entry level into any market is extremely hot. You know, there's one that recently just sold in Wembley for 165 and it was priced from offers from 1.5. That's now entry level into Wembley Downs. Performed extremely well. We picked up a villa unit in Mount Lawley, 3x1 for 780, and if that had gone to market, there would have been 40 or 50 groups through that property. So entry level into any suburb is still extremely hot. Finished product that's done well is still extremely, extremely active and going for with 15, 16 offers. The top end of town And a lot of that East Coast investment stock that was probably better performing over the last 12 months that was spoken about at the start of the year, that market, because those East Coast investors have taken a position elsewhere, we're starting to see that B, C, D quality stock just stabilise. It's certainly not coming off, but I have noticed that it's not as competitive as it was six months ago.
That's because those suburbs end up becoming self-fulfilling, right? When you've
Correct.
got that many East Coast investors swamping Gosnells, Rockingham, Kwinana, Mandurah areas, they're just bidding themselves up.
Correct.
The second that they're not there anymore, then it comes back to the fundamentals.
It's reliant so much on investment, and this is where sort of our model as a business has been very different in terms of where we invest. I've always said we will invest not where typically investors go because it saturates the market and you're relying on inflated figures from buyers agencies, East Coast buyers agencies to drive the market. Fundamentals are strong typically in owner-occupied dominated areas, whereby in a rising market, typically who pays more for a property? Likely owner-occupiers are quite emotional. So if you have that as an investment in your portfolio in a rising market at the top of the cycle, you're going to potentially outperform the market. But most importantly is risk mitigation. If the market was to flatten or is to come off, what's the first thing that typically comes out of the market? The investment stock.
And most specifically, the East Coast investment
Exactly.
stock. So you wouldn't want to be owning that property in that location if you were sensitive to short-term changes in prices or short-term interest stock levels as well.
Exactly. So that's why we always say to our clients, if we are looking at investment properties, we want to target those with owner-occupier appeal because both in good times and or stagnant times, there's always going to be a market for owner-occupiers, be that young professionals, family homes, be that people that want to live in a downsized unit or villa. If it's got the fundamentals of a strong owner-occupier, you're going to weather the storm of fluctuations of Armidale doing 36% in a year. That was 90% of that activity was driven by East Coast investors. Yes, it's great for that period. If you time it well and artificially inflate the market, get in early, get out, that's fantastic, but it's very dangerous if you don't time it correctly. Versus an owner-occupier suburb such as Duncraig, which is typically good school catchments, get in early on that market, there's always going to be demand for a well-located suburb with good fundamentals, good school catchments, proximity to CBD and ocean.
Well, Duncraig's done 19% in the last 12 months, and I'd suggest that's a very reasonable return for anyone buying into that area. Not a 36%, but a much more reliable return that you expect can continue into the future given income levels and the lack of need for people to sell if, for example, rising costs hit them. First place it's going are the fringes.
Exactly.
Let's segue into the investment market. And one thing that's starting to occur clearly in the maturity of this cycle in Western Australia is people finally have a bit of equity in their pockets, or at least book equity in their homes. We haven't had that sort of relationship with property for a decade, to be honest, and it's now a time that we can share the same level of aggression, the same courage in the market that we've seen these East Coast investors have from day one in 2019-20, to be honest. We finally, as a market, as a population in West Australia, should have 6 figures of equity in a lot of the properties they own for a year or more.
Correct.
Where are we putting it, Locke? What's the next step for those people who have got their equity in their first family home or in that first investor property? What's the next step that you'd be advising people to go towards? Are you consolidating towards better markets, seeking growth over yield, or the opposite? What would you suggest?
It first comes with a disclaimer that every independent situation is very different, and we'll speak to clients individually, but equity is typically the hardest thing to achieve for a lot of people to kickstart the portfolio. Now, initially when you start trying to invest in property, the hardest thing to achieve is your first deposit. Once you achieve that, you then can allocate that towards a home, and if it's placed correctly, then you get capital growth. That
Hope
capital
you don't
growth,
lose it.
Exactly. And look, there's been situations, even in my personal world, which I can talk to, where I've made poor decisions, particularly early in my property career. That set me back 5-6 years. So it's so important that the asset selection is at the forefront of that. So when people are in a position where they've got equity, they've been able to generate that through luck potentially, they've just timed the market and or it's been well placed at the right time. It's now making sure you don't undo all that good work. And if you are going to continue to expand the portfolio, getting diversification into the portfolio, understanding what that looks like.
Is it diversification of suburb, state, price point? What would you suggest is your go-to? I know your answer can be all of it, but what would you suggest is the first most accessible diversification people should be looking for?
Straight off the bat, we can look at location fundamentals to get diversification. We don't want all of our eggs in the same basket. For instance, if you had 5 properties in Armidale now, I'd be heavily considering allocating those funds into various markets. It could
consolidating.
Yeah, absolutely. It could be an East Coast opportunity. Equally, like I said, there's West Coast markets that still haven't performed at the same rate as others that we deem as local opportunities. But getting some diversification both in location and asset type and asset quality, be that you may have a family home on 800 square metres in blue chip suburbs such as Duncraig, trying to get some diversification with that through something with development upside, or it could be on the opposite end of the spectrum, a unit villa like I spoke to before in Mount Lawley, a 3x1.
That washes its own hands.
Exactly. So you're getting a different market demographic. One's a family home, we're going to attract upgraders in Duncraig versus a downsizing market in Mount Lawley. Okay, we're just getting some level of diversification, so we're not putting all of our chips in the one market at the one cycle. To complement that would be then, if you've already got 2 or 3 properties in Perth, we'll be starting to consider some of these East Coast markets, particularly Melbourne, we've got to focus on at the moment. But certainly the preference is, if you don't have that exposure in Perth, we'd be still looking locally. If you are oversaturated the Perth market, getting that East Coast exposure would be healthy.
I would offer a couple of alternatives to that as well. For example, my portfolio is purely Western Australian, whether it's commercial or it's industrial or it's residential or it's a development opportunity. So whilst it's certainly possible and clearly fruitful, you just look at these East Coast investors that have come through to diversify state by state and have a national portfolio. It also is slightly burdensome. It comes with some risk of not knowing exactly what you're buying, even though you've got professionals. My path of diversification has been diversifying asset type, really, within Western Australia, the market I would consider myself an expert.
Yep.
So that I can identify with as much control as possible and as much knowledge and information as possible where the opportunities lie in the area, the market, the economy that I live and breathe in every day. And it has transitioned personally for me from passive investment to small scale development, through to larger scale development, through to childcare, through to land development, and then commercial development, and then industrial development. Really following not only what my financial capacity is, which that's always a limiter, but also where I see the least risk in those sub-markets in Western Australia. And if you're just in residential, I would suggest you've got 2 sides of the coin, really. You're either chasing cash flow, which a lot of these people you see on the news who have got 58 properties, they've got micro properties, really units, flats that are all washing their hands from a cash flow perspective. Otherwise, banks are never lending to these people. Or it's the other side of the equation where they're just chasing land and development opportunity. The tough side for that is cash flow, right? We're struggling to actually pay for all these mortgages, and then eventually the bank will cap you out unless your personal income is supporting that. So
it's a balance of
as
that.
Far as you can afford, provide as much balance as possible.
Yep, absolutely. So when we look at portfolios, there's key things, right? 3 key things. You need to get comfortable with debt, because without debt, it's very difficult to build a portfolio at some level of momentum. It's very hard to save for large deposits, so therefore debt becomes our friend, and being comfortable with that. There's things we can put in play to protect that, like understanding your cash buffer, etc. Capital growth, so asset allocation is fundamentally the most important. You know, when we speak to clients, they're all very cash flow focused. The question I always ask is why you get into property, and it's typically to build equity, right? That becomes tangible. Equity becomes sort of your wealth position.
But they get sold the cash flow.
They get sold the cash flow, but I'm like, well, there's no, arguably, if it's just cash flow and you get no capital growth, is there any point in participating in your property? Yeah, something that's not quite as burdensome when you're looking at a debt. But then there's a cash flow scenario which needs to be understood to increase your portfolio. Cash flow is so important. So it's a collective of all 3, and you need to get it right to get into balance. And that's what we do, right? It's understanding capital growth is always at the forefront of our portfolios, understanding how we can maximise the cash flow. And there's ways, creative ways that we've been able to do that. And there's one thing to build a portfolio, there's another thing to manage a portfolio. And as we see with our clients all the time, that you're going to see a lot of experts in this market, right? A lot of people that potentially just fluked it.
Well, there's a lot of new experts in Perth's market in the last couple of years, Locke. Have you noticed?
There is. Every man his dog is now a buyer's agent. A local barber might be converting soon as well. So that does bring about some concerns, and just always be careful where you're getting your advice from, because everyone in this market does become an expert. That's great because people are making money, and it's been a favourable market for a lot of people to invest. But to do that in one cycle is one thing, to do it over a decade or 2 becomes another, and that's managing a portfolio. So I always talk about clients is fine to build a portfolio, but managing it over the long term becomes a harder task to fluke, and something that you need to do so carefully. We talk about these things, how to increase the cash flow and the serviceability to increase the portfolio side and the depth of the portfolio. And you can creatively do that by looking at ancillary improvements and or increasing cash flow through renovations or potential rooming solutions, renting out 4 rooms rather than the house itself, to give yourself more depth of borrowing, which then enables you to continue to grow the portfolio. But again, it comes down to asset selections at the forefront of that. If you aren't buying the right assets at the right time of the cycle and you don't get any capital growth, you're going to limit yourself. And anyone who invested in the market in 2014, 15, 16, it took them until 2019, 20 to then potentially look at their second investment.
Or at least that was when the market was just turning,
Yep.
probably a couple of years after that. You mentioned creative ways to assist with cash flow. Are you talking about granny flats or ancillary
Correct.
dwellings, dual key properties that would turn a $600 a week property into a $1,000 a week property?
Every asset that we analyse for clients when we do a portfolio review, we give them a highest and best use analysis. So looking at all those things, can we activate an additional income through a granny flat, ancillary improvement? Can we dual rent these rooms if it's got the floor plan that will allow for that? And we may have to spend some capital up front to accommodate to increase the cash flow. What is the highest and best use? Is a development site. There might be an opportunity for retained sub. Personally, it's what I started my portfolio. I was getting a lot of corner sites where I'd sell the land and reinvest that equity back into the property at the front, and then it would wash its hands. But instead of buying an off-the-plan apartment that's positively geared from day one, I've got a 3x1 renovated home in Inglewood where I've sold down the land at the rear on that property, pay off a large portion of the debt, so therefore it's become positively geared and I've been able to expand the portfolio that way. So it's just looking at the highest and best use, and that's what we do a lot of work with our clients, is to understand the highest and best use of every asset in their portfolio, as well as a rating on that property, because there's an opportunity cost. Typically banks will lend up 5 to 6 times your income, and at that point you've got to look at what's in your hand. And if the assets in your portfolio aren't A-grade assets that are going to have the uplift that we want to see in an investment portfolio, there's an opportunity cost of holding those assets.
Okay, so you're suggesting the principle that I've spoken about. Well, I haven't spoken about it for a while, but I remember speaking about this question you ask yourself. If you look at the properties in your portfolio and then ask yourself a simple question, would you buy that property today? Are you suggesting if the answer is no, then you should be seriously considering reinvesting or reworking the capital, the equity within that property into something that for the medium to longer term, given the transaction cost in the short term, is going to set you back on the right path?
Correct. When we talk portfolios, this is the problem in 2024. Everyone's looking for instant gratification, right? And you get these headline YouTube channels that we've made 50% across $500,000 in 2 years, and a lot of it's falsified, right? So we should always be looking at medium and long-term strategies. So if there's an opportunity cost in the portfolio where you've got a B, C or D grade asset and you're holding on, it's market dependent, obviously, but if you're holding on in the hope that someday that's going to turn a profit, then we need to look at that and review that to see if that allocation of those funds could be better used elsewhere in a higher growth market that over the medium to longer term is going to have a significant outperformance of what's currently in your portfolio. Because like I said, the bank's only going to give you X amount of dollars, and we can pull levers, we can increase income. But fundamentally, if we've got poor performing assets in the portfolio that we don't see any necessarily...
Ball and chain.
It is necessarily uplift in the
You
future.
own that ball and chain.
You do.
But it's a ball and chain nonetheless.
And a lot of the time you're putting pride on the side. Like I told you before we started this podcast, my first investment was an off-the-plan townhouse with my dad in country Victoria. Literally what I would tell every client I meet not to do. When I was 21 at university, thought I could outperform the market. I knew best because I was 21 and studying a property degree at Deakin University. I thought I could outperform the market. That problem with that asset cost me 5 years because the problem is there's no capital growth. Cash flow was okay, but without capital growth, I was unable to build the equity for the second purchase.
You were locked into that investment.
Yeah, and I learned a lot from that. Was able to get out without losing too much. A lot of people, when they make a bad investment, lose money. But then learnt from that, and then I was able to, obviously buy 2, 3, 4 properties, ensure to success and learning the mistakes from that asset.
Let's look forward. One of the themes I've been pushing out through this podcast, through radio, through TV over the last couple of weeks has been the progression of this cycle. There's a bit of alliteration here. A couple of years ago, the theme was affordability. This year, the theme has been access. Next year, I believe that theme is going to be amenity. And I'm not sure if you've been listening to the last few episodes. I'm sure you have been.
Of course, mate. I don't miss one. Of course.
But the reason I call it the theme for next year, amenity, is as we expect to start seeing serviceability increase artificially simply through cash rate drops, people will start to have the ability to access those properties with more amenity than they have been able to in the last couple of years where interest rates have been so high. And so in the microcosm, the local government areas, each of them in Perth metro area especially, I expect we're going to start seeing people with the equity that they have built, if they are in the market right now, at the lower end of the market in that local government, let's say it's in the city of Canning and it's maybe Ferndale or Parkwood, use that equity as their deposit and the increased serviceability through lower interest rates to that now go, well, finally I can compete in Riverton, in Shelley, in Rossmoyne, and move to the places that they really wish they would have bought in 5 or 6 years ago that maybe they could have afforded back then, but missed the boat on, got in at the bottom end of that micro economy. And this is the first opportunity they'll probably have in a couple of years to make that preference jump, that upsize, which talks also to the experience a lot of the most expensive suburbs in the microcosms have been experiencing over the last couple of years with high interest rates. Would you subscribe to that we're going to see a little bit of many micro migrations up the amenity curve?
Yeah, without a doubt. I do agree. We're going to see, and as we've seen previously, when money becomes cheaper, which I think the CBA come out and said there's going to be potentially 1.5% cuts across that, which is very significant. It gives people more serviceability, right? So I do think you're going to see a lot of upgrading. Pre-approvals at 1.2, all of a sudden it might increase to circa 1.4, 1.45. What typically do they do?
They aspire.
Of course they do, because what you can buy at 1.2 is very different from what you can buy at 1.45. And you're coming off a place of equity potentially. So all those fundamentals start to support potentially paying more. So naturally next year, like I said, I think it will be driven by a serviceability increase, and those aspiring suburbs that we've seen probably soften off a little bit in the last 3 to 6 months.
Well, doing a 19% instead of a 32%.
Exactly. Yeah, we call that softening. We will start to see those, particularly those driven by owner occupiers, really start to move into the early part to mid part of next year, I believe.
What about West Australian investors? This is probably the first opportunity we're seeing as the East Coast guys go back. It's finally the opportunity for Western Australians with equity to start making their moves.
Exactly. And I don't think we're going to lose the East Coast investors. I think just the dominator markets at the lower end of the suburbs have tried to artificially create other solutions on the East Coast because it's, like I said, accessibility. But I still think for a sophisticated investor, East Coast investor, they're going to see Western Australian data sets and really make a case for it. So I don't think they will be out of the market. And like I said, I think next year we will see Western Australian own occupiers competing with Western Australian investors because we do have equity. They understand the market. They know the market. It's very convenient for Western Australians to invest in Western Australia. So we're going to see that play out, like I said, once interest rates start coming off. And there's an argument to suggest it could be at the back end of this year. I think you're in disagreement with that.
I think the RBA has got too much face to protect, given the Stevens issue after COVID. I think that regardless of whether the data says that they should drop, they won't until the 1st of January onwards, being February, the first meeting. Yeah,
first meeting. Well, when inflation's falling like a rock at the moment, it's going to be a lot of pressure to see where that plays out. But like you said,
markets move on expectations so a lot.
They do.
Not realities often. So the second that we get out of Christmas, we have that usual push, as we've seen for 5 years straight now, firsthand since COVID, that usual January, February push that will then be inflated, that pressure, by either the reality or the very strong expectation being pushed through the media and in general in the public of rate drops. They'll be pricing in their increased affordability.
Exactly. Yep. And that's what I think is going to happen early next year. Like I said, seasonally, January, February is a very strong period of time. And so looking at the market, looking at people that haven't suffered complete buyer fatigue, I think there is going to be some really good buying over the next couple of months, as I stated before, because that buyer fatigue has set in for a lot of individuals.
So for people with the ability, you're saying there's a window for the next couple of months before we do see that real sugar hit from interest rate drops.
Yep. Look, I don't think you're going to miss that opportunity. I think if it's going to be February when the rates start coming down, you've got a window of 3 months where it may be better buying than it will be in 3 to 6 months' time.
All right. Question without notice, and there's expectation on this question. You need to answer it. And I know it's something that you're very protective of in terms of the information. Where will you be focusing next year in terms of, I know we probably foreshadowed this, but some locations, some regions, as specific as you want to make it, I want an answer. Where will performance be looking to buy? Either what is it and or where is it? Like this year it was renovation homes and properties you could upcycle.
High quality owner-occupier stock will be at the forefront of what we're looking for. In a falling interest rate environment, the most competitive markets are going to be entry-level owner-occupier stock in any suburb, the areas that we're buying in. If we can double down on that, we're going to see the uplift over the next few years in that market.
People who are, I guess, influenced heavily by debt because they're stretching. And that obviously brings us back full circle to 2019-20, where it was that owner-occupied home that was the first to have a run, because that's what people initially were accessing, were wanting with the lower interest rates. There was a huge run on owner-occupied properties.
And when you look at cycles,
as interest rates drop again, people come back to the thing that is most preferred in this state, and that is 4x2 with the backyard.
Correct. And if you look at any cycle, not just Perth, it's always good to look at other markets and how they've performed. You typically start a cycle with a high level of owner-occupier activity, then you get a high surge of investment activity, which leads to those outer belt areas in comparison to what was blue chip inner suburbs. That price differentiation isn't as much as it was 3 to 5 years. It's very flat. So then there becomes an opportunity. Why am I paying similar prices in what was considered a superior suburb to an out of further suburb? Then that gap becomes an opportunity for those owner-occupiers to push prices up. So in the last part of the cycle, which I don't think we're going into, but I just think
we're going into third gear.
Yeah, I think we're going into third gear, and the interest rates will come off, and those upgraded suburbs will make a charge.
Lachlan Delahunty, Director at Performance Property, thank you very much for your time again, mate. It's nice to get a feeling on the ground of someone who is managing a team that's buying tens of properties every month. So it's nice to hear that transparency of that fatigue coming through the market right now. Yep. I see it as an opportunity. It's been pretty evident that people are getting a bit tired of having to pay more and being bidded up more and more and more. I foreshadow that next year is going to get even more of a kerosene on the fire. So let's use that fatigue if we're buyers in the market and we're ready to go and we've got our pre-approval. This is your time to act. Cheers, mate.
Thanks, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!